So the S&P 500 has officially entered bear market territory as its losses year to date have gone over the 20% mark. And it doesn't stop there. As we've previously covered on the channel, the likes of Tesla is down over 45% year to date, and even stocks such as Peloton are down as heavy as 75% year to date. So things are not looking good at all across the stock market. And to be honest, with the likelihood that a recession is currently brewing in the US, things do not look like they'll be getting better anytime soon. So with that information, as the title of this video suggests, is it time to stop buying the dip? Also, before we go any further, if you could take a second to drop a like on this video, it would be very much appreciated and really does help out the channel. We've always heard that buying the dip is the right thing to do in the stocks that you like and have conviction in, and technically it does make sense. But what happens when you buy the dip and it keeps on dipping? Because that's been the case for us pretty much since January. We see a slight dip, maybe 5%, we buy the dip, it keeps going further and further, and we're not yet seeing a return on the money that we're investing. In order to answer this question, I basically have two strategies that I want to go over in this video, so let's get into that. So the first one draws along the Warren Buffett saying of be greedy when others are fearful and fearful when others are greedy. And just to explain that one a little bit further, essentially people are greedy when things are going very well, and that's basically what we've seen for most of 2021. The stock market and cryptocurrency and basically every type of asset was on the up and up, and to be quite honest, people were getting greedy. So in that situation, according to Warren Buffett's quote, you would say be fearful in these situations if you're to be a level-headed investor. And what being fearful in a situation like this may involve is taking some profits as your stocks continue to go up. Don't just think that they'll consistently go up forever, because as we can see right now, that is obviously not the case. And also being ready in case stock market conditions change, such as we go into a recession or there's been a big 20% dip or something like that. Just start to prepare yourself, maybe bring up some cash reserves, and then be able to take advantage of these opportunities. Of course, it's easier said than done, and in the moment, like we were in 2021, everybody thought there was much more to run in that current bull run, but things change, and things change very quickly, as we've seen. So it's definitely something that I'm sure will take a lot of practice, something I'm still working on myself, being able to recognize when the market is being greedy and how I can change my strategy slightly in order to become a bit more fearful in them scenarios. And then the other side of that coin, the other side of that phrase is to be greedy when other people are fearful, and that's essentially in market conditions like we're in right now. So pretty much anybody you ask right now who hasn't been investing for years, especially a lot of the new people, if you ask them what are their current thoughts on the stock market, a lot of them are probably going to say they're fearful. And the greed index, which essentially shows how fearful or greedy the whole stock market is at any one time, is right down there at peak fear. And essentially what this behavior leads to is people not wanting to invest their money in stocks or crypto because that's just consistently going down. And people's outlook on the economy, which is probably warranted right now, is not very good, and they're not too excited about investing their money in the likes of stocks and crypto. And it's leading to a lot of people selling off their positions as well, as companies come out with bad quarter earnings, bad guidance on future quarters, and that's where we're seeing a lot of these stocks drop quite dramatically. But if we were to follow Warren Buffett's quote here and be greedy in this circumstance, it may be an idea to be buying up these dips. As I said, Tesla down 45%, which I think is a great opportunity. Also, we have the likes of Peloton, which is down 75%, one that I won't be investing into myself personally, but if you really believe in that company, it's probably a good time to be greedy with that and be able to pick up the stock at much lower prices. So essentially with this strategy, it's more spotting opportunities in the market when things are at a huge discount, not even worrying if they go a bit more. If they do, you just continue to buy more. Essentially, this strategy is all about buying the dip when the opportunity presents itself. So you be greedy when other people are fearful. One thing with this strategy that you'll definitely realize if you try to implement it is it's a lot easier to say you're going to buy stocks low and sell them high. But when stocks are dropping, even the likes of Tesla, which I'm very, very confident in, when that's dropping 30, 40, 50%, it's a lot harder to put your money in there with a lot of confidence. Because we never know exactly when these stocks will recover, we can only assume and hope, but there's no way of knowing for certain when exactly we'll start to see that return on our investment. But when things are going up each day, 2, 3, 5%, it's a lot easier to throw your money in. Sure, you're paying higher prices each day, but you're happy because you see your overall balance going up. But in reality, when you're getting stocks at a lower price, it's obviously less risk because the stock has less distance to fall, and you're picking up more shares for the same amount of money. So obviously it makes more sense to buy low. But I'm just saying that obviously it is a bit of a mental struggle to be able to actually force yourself to put the money into the stock. Even though you know it makes sense probably in the long term, it is a harder thing to do. But obviously a great strategy to follow if you can stick to it. And then we come to the second strategy, which is aligned with the title of this video, which is essentially taking a bit of a breather and stop buying that dip. And I appreciate this is probably counterintuitive to a lot of what you hear on a regular basis. Pretty much buy the dip is just, that's what everybody says, buy the dip. And as I said, it often does make a lot of sense, but let's at least consider the alternative of stopping buying the dip. So a situation where you would deploy this is in something like right now where the economic conditions are quite bad. We've seen things fall quite a bit, but you don't think that things are going to get better anytime soon. This could be a good idea to implement this strategy. Essentially what you would do here, and obviously people can take varying degrees of how they want to do this, but for example, you wouldn't exactly sell out of all your stocks or anything like that. Maybe you might sell a small percentage of them if you still had some profits on some stocks and wanted to do that for tax purposes. So generally there wouldn't be much selling of the stock portfolio that you currently hold, but in terms of continuing to add to it on a monthly, weekly or whatever basis you do, you may decide to, instead of putting €100 in a week, you may decide to do maybe €50 a week or €30 a week. So you're continuing to dollar cost average in. So instead of putting in your regular amount into the stock market each week or month, so let's say for example you regularly put in €100 a week, what you would do instead in this strategy is basically just put that in your cash reserves. You wouldn't go off and spend it on other frivolous things. You definitely keep it there aside and will be assigned to investing at some stage, but for now it would go into a cash reserve. And essentially then you would keep an eye on the stock market, but essentially let it do its thing because you believe that there's a recession, for example, coming. You believe that a lot of companies will post terrible Q2 results, which is something that I probably think will happen. But overall, you just think the next probably 2 or 3 months, if not further, won't be very good for the stock market, and you don't see stock prices recovering just yet. So instead of buying the dip and waiting for it to go lower and then buying the dip again and constantly buying it all the way down, instead what you're doing is kind of waiting for a bit of a bigger drop. Now of course this is kind of like timing the market, which of course is absolutely impossible. Nobody can time the market like that. But essentially what it is preparing yourself that if it does come out that we're in a recession and the stock market reacts negatively, that you're able to use them cash reserves you've been saving aside and then buy the stocks at a substantial dip, opposed to just be buying it all the way along. And the idea here is obviously that you get more quantities of your favorite stocks for cheaper than you would have if you were buying on the way down. Now naturally your thesis could be wrong, and in this case for example we may not go into a recession. Companies may post good Q2 results and that will likely send the stock market on an upward trend. And in this scenario then you can decide to just continue your regular investing. Instead of putting that €100 into cash, now you can start to pick it up again as the stock market is trending upwards and just start to invest that every week again as normal. Will you have missed out on some potential buying opportunities? Sure you would have, but that's the risk you took when you're taking on this strategy. You had an overall feeling that you thought the markets were going to go lower based on economic factors and the likelihood of a recession, and you were willing to take that risk on missing out on some potential prices now in the hope that they will go lower. And again, even as I'm saying this, I do appreciate it sounds like timing the market, but it's not like you're sitting there trying to time a chart whether in the next 5 minutes it will go up or down. This is basically taking a step back, looking at the overall economic market and just not having too much confidence in the stocks right now, and believing that we are in a recession and we will see this drop. So it's something that you're willing to take the risk on. Basically the opportunity cost of buying now, you believe that the stocks will go lower later. So if we were to take a step back and look at both approaches, if I had to choose one, I would obviously go for the first approach of buying the dip and being greedy when others are fearful. But I am leaning towards this second strategy at the minute because I do think a recession is basically happening right now, and we'll find that out in the next couple of weeks. And I personally think we could see prices drop 5, 10, 20% lower on some of our favorite stocks here, including Tesla, unfortunately. So essentially what I'm doing is adopting a hybrid between these two approaches. Nothing has to be completely all of one or completely all of the other. It's completely fine to have a hybrid strategy. So what I'm doing, for example, is let's say I was investing €100 a week. Now I'm putting €50 a week in and putting €50 in the cash reserves to be able to prepare for if something does happen to go wrong and we do see these dips. I'll be able to take advantage of them, but I also haven't completely missed out on buying the dip on the way down as well. And then when we get a clearer picture, as I mentioned before, the Q2 results, when they start to come out, when we realize if we were in a recession and how bad it is, and we get a better idea of how long it might take to recover, then I can start to reassess my strategy and see if it's a good idea to continue putting my €100 a week into buying the dip, or if it's better to wait a while. Let's see if the prices drop, and if they do, then I can start to utilize them cash reserves that I've been saving up as well. So it's a bit more of a conservative approach that I'm deciding to follow, not exactly just blindly dollar cost averaging in. Although if you're focusing on more the long term, the 8 to 10 years, you're not focusing too much on the kind of shorter 2 to 3 years, I think it just does make a lot of sense to just be consistently dollar cost averaging, buying the dips when they come up and not worrying too much about if I'm going to try and make another 10 or 20% here in the next couple of months. It does make a lot of sense really when you zoom out to just keep dollar cost averaging in. But for me, who's basically keeping an eye on the stock market every single day and watching news and stuff, I feel like just based on the current sentiment that it's a good idea to implement my hybrid strategy for now. But anyway guys, that's just me. I would love to know your opinions on my strategy here and what you guys are doing in the current stock market and cryptocurrency market conditions. Do you think that we're currently in a recession? Let me know in the comment section below. I'd love to know all your thoughts on it. And as I said previously, if you could take a second to drop a like on this video, really would appreciate it. And please consider subscribing if you're new around here as well.